Hello everyone, in this video, I will share a specific entry point that I have never shared before, and I also affirm that if you practice it thoroughly, it will definitely be one of the most powerful weapons. This video may be one of the most dedicated videos I have ever made. I will explain in detail so that both beginners and experienced traders can understand. Please prepare pen and paper to take notes and be prepared to rewatch the video multiple times for better understanding. As my English is not very good, if you have any questions, please comment below the video and I will help you clarify. I have gone through many years of wasting time with ineffective methods and complicated indicators, only to eventually realize that the simpler the trading approach, the more effective it is. Simplifying trading is the key. To start, we need to talk about market structure. You may have heard of the 3 stages of the market: uptrend, downtrend, and sideways, but to be more clear, I will divide it into 4 stages: uptrend, downtrend, sideways with rules, sideways with no rules. An uptrend consists of consecutive waves making higher highs and higher lows, similar to a downtrend where consecutive waves make lower lows and lower highs. That is the theory that most of us have been taught, and this theory is not entirely wrong. However, there will be times when the market goes up or down in a single move, so what then? Therefore, for me, you may not need to focus too much on the exact meaning of this, as there is no theory that is 100% accurate in this market. Simplify it with your own perception. If you see the market recently going down, then it's going down. If it's moving sideways, then it's sideways. If it's going up, then it's going up. Let's simplify everything like that for now. Next, I will talk about the sideways phase with and without rules. The sideways structure with rules means that the price moves sideways within a consistent range, easily noticeable, for example in a rectangle or a triangle pattern. In this chart, we can also see phases where the price moves sideways with rules. This is the sideways phase within the range of a rectangle. Or this phase is the sideways phase within the range of a triangle. Or here, it may be difficult to recognize because this range is quite large, but let's zoom in for a closer look. The sideways structure without rules means that the price moves sideways but continuously scans the top, scans the bottom, and then reverses. In this phase, many candlestick wicks will appear. Continuing in this chart, we can easily identify such phases, which may be these phases or those phases, although they still fall within a sideways structure with rules of a larger time frame. Or this phase, we can see a breakdown here, but immediately after, it reverses to scan this top, so if you are buying or selling in this case, you are at high risk of being stopped out, especially if you are using limit orders. So the first thing we need to do is to focus on phases with clear trends and sideways phases with rules, and stay out of the market during sideways phases without rules. You can easily spot such phases with the naked eye if you use charts without indicators. It may take some time to get used to at first, but practice gradually. And now we begin to delve into the detailed steps to identify a clear entry point. Step 1. We will identify potential buying and selling zones in different stages of the market. For an uptrend, for example, we have a trend like this. The market is a struggle between the buying side and the selling side. The buying side pushes the price up to this level, and the selling side pushes the price down. Then the buying side, which is stronger, continues to push the price up. So when the uptrend breaks through the previous high, we will have 2 potential buying zones, which I call buying zones. The first zone is the starting zone of a wave, and the other zone is the old high that has just been broken. Why are these 2 potential buying zones? For the starting zone of a wave, it is the transition zone from price decline to price increase, meaning that the selling side is losing its advantage to the buying side, so it pushes the price up. Therefore, when the price rebounds to these zones, the buying side will tend to continue buying. What about the zone where the old high is broken? The old high zone is where the selling side rushed in. At this point, when the price is broken, the selling side has already rushed in once, so when the price returns to this zone, the selling side will tend to come in again. However, the buying side is stronger and pushes the price up. So at this zone, it also needs strong buying pressure for the price to break through the previous high. Therefore, this is also a potential buying zone. And these two buying zones will be confirmed if there are strong bullish candles and strong upward waves at these zones, which are the moments of price momentum or the strength of the price. However, we have a note like this: if now the price does not break through many zones but only breaks through one section and then reverses, like this. So can we still buy at this zone? At this point, we can also see that the buying side is weak and the selling side immediately rushes in and pushes the price down again. So this zone is no longer a strong buying zone, and buying at these zones will be much more dangerous. In addition, if the price breaks out too far and then retraces back to this area, can we still consider buying? We notice that when the price breaks out strongly but then retraces back to this area, especially with a strong force, it indicates that the selling side is dominant, taking the upper hand over the buying side. Therefore, in this case, this area is no longer a good buying zone. That's why we use Fibonacci when a wave breaks above the previous high and then retraces to the Fibonacci level of 0.5 to 0.618, coinciding with the previous high. Then this area becomes a good buying zone. Because the price doesn't rise too weakly or too strongly, in this case, Fibonacci is effective, not because we like to use it, but because it shows the balance between waves. Therefore, when Fibonacci coincides with this area, this becomes a good buying zone. You should not apply it mechanically, but rather understand it in a simple way to help us differentiate between better and worse buying and selling zones. And to have a good entry point, it requires not only this factor but also many other factors. Similarly, for downtrends, it's the opposite. We'd apply it to identify potential selling zones. As for cases where the price moves sideways within a range, for example, within the range of a rectangle or triangle pattern, we can determine the buying and selling zones as the edges of the rectangle or the edges of the triangle, especially in cases where the price breaks out of these zones and then retests them. That's how we determine what are potential buying and selling zones in different scenarios. Step 2. We need to identify signals to enter a trade. In an uptrend, after identifying a potential buying zone, a good entry signal is a signal that shows the exhaustion of the selling side, and the buying side starts to confirm its dominance. Identifying entry signals is also crucial because if we only wait for resistance levels to limit, there will be significant risks. When approaching a potential buying zone, the price can go through three scenarios. First, it reaches the buying zone and reverses. Second, it breaks through and then reverses, which is often referred to as a false breakout. Third, it does not reverse and continues to go down. Therefore, in these three scenarios, if we do not wait for signals and enter the trade immediately, there will be two cases where we hit stop loss, and that is why identifying entry signals is crucial. To identify a buying signal, it will consist of three phases. The first phase is the weakening of the selling side. For candles, it can be seen through candles with small lower wicks, or for waves in smaller time frames, there will be more green candles, and the momentum of the price will no longer be upward, but starting to flatten. The second phase is the dispute between the buying and selling sides. For candles, it can be a few small-bodied candles that are not clear, and this phase will be clearer if there are more than two candles. For waves in smaller time frames, it can be a sideways price movement. The third phase is the confirmation of the trend continuation. After the dispute phase, there will be a strong bullish candle with a long body, breaking through the previous dispute phase. Now we will go through some examples of cases where we should enter a trade and cases where we should not. In this case we have just analyzed, it is also a point of entry which has a clear tendency to rise, a good signal to enter the trade. As there is no resistance ahead, we set our take profit level at 2R. In this case, let's look closely at this area. This is not a strong buying zone. It previously broke through the old high, but the strength was very weak. Therefore, in this case, our potential buying zone is this area. And here we can also see clear entry signals. First, the weakness of the selling side is shown through very long lower shadow candles. Second, the consolidation phase can be seen in these four candles. Some candles have both long upper and lower shadows, and it oscillates within this range. Third, this candle confirms the continuation of the trend. It broke through this consolidation zone with strength. Therefore, this is a beautiful entry signal. Those are some examples of cases where we should enter a trade and also cases where we should not. At the end of this video, I also want to say a few things to you. Most traders in the market want to enter a few trades every day because they think they can make money only by doing so. But the truth is, professional traders only wait for the best entry points. They wait for clear market structures and then wait for a beautiful signal according to their rules. They find more reasons not to enter a trade than reasons to enter, and as long as one reason does not support them, they are ready to stand outside and not risk their money. When your R value is large, you will understand this. When your R value is small, you may be willing to take risks, but when the R value is large, your psychology will be different, and you will definitely need to be more cautious. And finally, the key point is that you need to practice many times to get used to and enter the method correctly. Secondly, you always need to manage capital on each trade that you enter. And thirdly, you need to be patient to enter according to the rules. If you find this video useful, please like and subscribe to not miss other videos when I publish them. Goodbye and see you in the next videos.